What's up everybody, Gen X Dividend Investor here. I hope everyone has an awesome new year, and in this video I'm going to tell you about 7 cheap dividend stocks that have over 10 consecutive years of dividend increases, all of which I and professional analysts estimate are at least 10% underpriced, one of which I intend to start a position in. Of course, that doesn't mean you should run out and buy or sell anything without doing your own research. I'm not a professional, and me thinking something is underpriced doesn't mean it's guaranteed to go up. And be aware that this isn't a stock analysis video. I'm just giving you a few useful metrics to be aware of, but you should always dig much deeper to understand a business's financial statements, trends, risks, and their competitors and such before ever doing any trading. Like, you really want to understand a company's trends in revenue, income, cash flow, debt, shares outstanding, and stuff before you ever buy. And by understand, I mean not just look at a graph, but understand the why behind the data and be able to formulate a hypothesis on what you think will happen in the future. Finally, if you aren't Emperor Palpatine, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, I'll just be sharing these stocks based on alphabetical ordering of their sectors. Also, if you're new to my channel, then I recommend you watch my Cheap Dividend Stocks in November 2021 video to learn about how stocks prices move in relation to intrinsic value, which I feel is one of the most important things to learn if you want to improve your gains when investing. Anyways, the analyst price in this spreadsheet is the average or median price of what a bunch of professional stock analysts forecast the stock's price will be at 1 year from today. I know some of you don't care what analysts say, as they are often wrong or biased, but I'm obviously biased and I personally find value in hearing what experts think. I created this video in the last week of December, so prices might have fluctuated from when you were watching. The first stock in my list is Altria, ticker MO, a stock I'm long in. They face a lot of headwinds from increased regulations and from generally declining sales of their main products, which they counter with price hikes along with new product innovation. As an example of regulation concerns, New Zealand has a law expected to go live that will make it illegal for anyone born after 2008 to buy cigs in their lifetime. So will other countries follow suit? Beyond that, MO recently lost a patent ruling on their heated product line against R.J. Reynolds, which is a subsidiary of British American Tobacco, which I think will hurt them in the short run but not the long run, because they will probably just create new designs that circumvent the patent issue. Still, even with those concerns, I believe that many people will continue to use their products, and as they develop new innovations, they'll find new customers. So if you need cash flow now, then MO becomes more compelling. My 1-year fair value target price estimate for MO is $65, which is almost 40% higher than it is today, as compared to analysts who have it at $53, which is about 14% above today's prices. MO has a high 7.71% yield, a nice 8.4% 5-year dividend CAGR, a 78% payout ratio, which normally is considered high, but is where their management team targets, and they have an amazing 51 consecutive years of dividend increases and are a dividend king. Dividends pay all my bills and have allowed me to retire early, and my diversified dividend portfolio is built to enable my family's needs, both now and in the future. Thus, each stock has a purpose. MO is one I'm long in as an income-generating vehicle in retirement, though I don't see them as a great long-term stock appreciation play. Other dividend stocks I own, like Apple and Microsoft, are more about their future potentials rather than current income. Okay, let's move on to another sin stock in this list, and that's British American Tobacco, ticker BTI. They obviously face many similar problems as Altria, though their heated product lines show interesting potential. My 1-year fair value target price estimate for BTI is $55, which is about 48% higher than it is today, as compared to analysts who have it at $51, which is about 38% above today's prices. BTI has a high 8% yield, a decent 6.3% 5-year dividend CAGR, a 68% payout ratio, and at least 20 consecutive years of dividend increases. I say at least because their website shows their last 15 years of increases, though a European dividend site said that they had 20 plus. Anyways, due to currency fluctuations, it's possible that a situation could happen where they increase their div, but the actual payout in dollars doesn't increase. But I like BTI's metrics and product line potential enough that I've decided to establish a position in them as an income play, and I'll DCA in a bit here and there since I'm not sitting on loads of cash. Okay, now we'll go over a consumer discretionary stock that I'm long in and that I feel is cheap and that recently became a dividend king, and that's Leggett & Platt, ticker LEG, a company which focuses on home furnishings like bed springs. Right now, the pandemic has increased their costs due to supply chain issues, and that has hurt their stock price. My 1-year fair value target price for LEG is $45, which is about 13% higher than it is today, as compared to analysts who have it at $51.50, which is almost 30% higher than today. LEG has a nice 4.25% yield, a mediocre 4.4% 5-year dividend CAGR, a 61% payout ratio, and they have an awesome 50 consecutive years of dividend increases. Okay, let's move on. The next stock on the list is Enterprise Products Partners, ticker EPD, a midstream natural gas and crude oil pipeline company. They have around 50,000 miles of pipelines and hundreds of millions of barrels of storage facilities, along with multiple natural gas processing plants and deep water docks. They face some risks such as potential of higher taxation from the current administration and risks from the pandemic, which could hamper some aspects of their demand. My one-year fair value target price estimate for EPD is $30, which is almost 40% higher than it is today, as compared to analysts who have it at $29, which is 35% above today's prices. EPD is a high 8.38% yield, a low 2.5% 5-year dividend CAGR, a high 83% payout ratio, and 22 consecutive years of dividend increases. An obvious risk with companies like EPD is that they're focused on the fossil fuel industry, which has various headwinds, with bulls seeing this as an opportune buying time because they see how integral fossil fuels are for many years, while bears are moving elsewhere. So for me personally, I'd see them more as a cash play now, rather than as a generational play to grow your net worth. Be aware that EPD is a master limited partnership, which means it has a more complicated structure than a normal corporation. Thus, there are tax issues to be aware of, such as an annual K-1. Okay, the next stock that I feel is on sale is Bristol Myers Squibb, ticker BMY, a pharma company. My one-year fair value target price for BMY is $80, which is almost 29% higher than it is today, as compared to analysts which have it at $72, which is 16% above today's prices. BMY has a decent 3.48% yield, an okay 5.2% 5-year dividend CAGR, a nice 29% payout ratio, and 13 consecutive years of dividend increases. My main concerns with BMY are, number 1, a drug pipeline that isn't that great, number 2, the government and the risk of regulations, and number 3, lawsuits. They also have some debt to be aware of. Okay, the last healthcare stock on the list is McKesson Corporation, ticker MCK, which provides healthcare supply chain management, retail pharmacy, and healthcare information solutions, amongst others. My one-year fair value target price for McKesson is $265, which is about 10% higher than it is today, as compared to analysts who have it at $269, which is about 11% above today's prices. MCK has a very low 0.78% yield, a good 9.7% 5-year dividend CAGR, a very low 8% payout ratio, and 13 consecutive years of dividend increases. Their management team has done a nice job using share buybacks to drive their share counts down to help their EPS. They have some decent free cash flow yields, though their operating margins could be better. They've done some acquisitions which were fairly costly, and they have the opioid mess to deal with. Okay, the next stock on the list is a financials, and it's Goldman Sachs, ticker GS, which is a well-known investment banking and wealth management firm. My one-year fair value target price for Goldman is $475, which is about 22% higher than it is today, as compared to analysts who have it at $460, which is about 19% above today's prices. GS has a 2.08% yield, an awesome 20% 5-year dividend CAGR, a very low 13% payout ratio, and 10 consecutive years of dividend increases. This stock has been pushed up by Fed liquidity and all the fiscal stimulus, and Goldman has been performing well. Their hiring practices remind me of Google in that they get some of the best minds in the world. I've not been a big fan of financials since 2008, but GS is one of the best, though there are never any guarantees with investing. They really look compelling from a price-to-book basis as compared to their peers, even after their price appreciation this year. Okay, let's move on. The last stock on the list is in the out-of-favor telecom sector, and that's Verizon, ticker VZ, though I'll also talk about AT&T. My one-year fair value target price for Verizon is $65, which is about 23% higher than it is today, as compared to analysts who have it at $59, which is about 12% above today's prices. Verizon has a nice 4.86% yield, a weak 2.1% 5-year dividend CAGR, a good 48% payout ratio, and 16 consecutive years of dividend increases. Verizon and AT&T are the top 2 dividend telecom companies in the USA. Telecommunications is almost as important to society today as electricity or water is, thus I wouldn't be surprised if they are deemed too critical to fail, which might also mean that they have a government safety net as another arrow in their quiver of longevity. Part of their moats are from the high costs it takes to compete, costs from building and maintaining 5G and older infrastructure, and costs from building networking spectrum. Both Verizon and AT&T have over $100 billion in debt. AT&T has more debt and pays higher interest rates on some of their debt, but lately T's debt has been trending down and VZ's debt has been trending up. AT&T has been beaten down even more because they announced that they're planning to cut their dividend by probably 50% when they spin off their Warner Media HBO division and merge it with Discovery Networks, and to compensate for that dividend cut you'd get shares of a new streaming company. Thus, T is no longer a dividend aristocrat and would fall off the requirements for this list. Many people who had invested in them primarily for the dividend got understandably pissed off and sold. That all being said, AT&T should become a stronger pure telecom play relative to itself, and Warner Discovery should be a real streaming competitor since they have some great content as well as planned content, and it looks like they'll be run by some strong streaming leadership. My guesstimate is that AT&T will end with less debt than Verizon, more revenue than Verizon, and faster EPS growth than Verizon. But Verizon will lead AT&T in a variety of other metrics, and I ultimately like Verizon enough that I'd be happy to start a position in them. I also feel the market is undervaluing Warner Discovery, and that's why I plan to hold on to some of their shares as part of my non-dividend portfolio, which already has a couple other streaming companies in it, Netflix and Disney. I'll probably sell some shares of it to get the weightings of both my portfolios to a point that aligns to my needs and goals. The reality is that both T and VZ were higher in the 90s than they are today. T has done some terrible acquisitions and both have tons of debt, as I mentioned. So, kinda like Sen stocks, I see these telecom guys as useful if you need current income to live, but I wouldn't be investing in them if you're young and focused on growing your net worth. Now, T has a wildcard aspect in it in Warner Discovery, but it will be laden with quite a bit of debt, so it's not a sure thing either. Not that anything is. You could always get into it via the Discovery path if you see upside only in it and want to get in now. Regardless, you need to identify your needs and goals and then invest as makes sense to you. Now, I want to share a few other dividend stocks that I feel are cheap, but didn't meet all my criteria. I'll just rattle through them and let you dig deeper if you feel so inclined. So those are AbbVie, most Canadian big banks, Intel, Aflac, Prudential, Walgreens Boots Alliance, Cardinal Health, and Amgen. Finally, I strongly recommend you join my free dividend Discord by clicking on the link in the description of this video, or you can download the Discord smartphone app and type in lowercase kk, capital S, lowercase r, 5, capital F, capital Y in the invite field to join up. PM me once you join my server and agree to the rules in order for me to authorize you for faster access. Once you join, you can chat or lurk with thousands of other dividend investors from around the world. Of course, please hit the thumbs up button in this video, subscribe if you haven't yet, and click that bell notification. Thanks for watching, Happy New Year, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.